JEPI stands for JPMorgan Equity Premium Income ETF. This fund was launched in May of the year 2020 by JP Morgan Asset Management, and it has quickly become one of the most popular dividend ETFs in the world. The mission of JEPI is simple. It aims to deliver consistent monthly income while keeping portfolio volatility lower than the broader stock market. Instead of just tracking the S&P 500, JEPI takes a smarter approach. It selects stocks with lower volatility and stronger fundamentals, and then combines that with an options overlay strategy to boost income. Let me break down exactly how it works in plain English. JEPI holds around 70 to 90 stocks that are handpicked from the S&P 500 index. These are mostly large, stable companies with solid balance sheets and lower price swings. Think names like Coca-Cola, Progressive, and AbbVie. Unlike traditional S&P 500 ETFs like SPY or VOO, JEPI tries to smooth out the ride by focusing on companies less likely to crash when markets get shaky. But what makes JEPI truly unique is what it layers on top of those stocks. This is where the options overlay comes in. JEPI uses something called equity-linked notes, or ELNs. These are structured notes created by banks that simulate the return of selling call options on the S&P 500. In plain English, it means JEPI is selling upside potential to generate immediate income. It collects premium each month from investors who want the chance to buy the market at a fixed price. JEPI gives up some of the market's gains, but in return it gets cash income every single month. This is what allows it to pay high monthly dividends regardless of whether the stock market is rising or falling. On average, JEPI has paid a yield between 8 and 10% over the last 2 years, depending on market conditions. That means if you invested $10,000, you could receive close to $800 to $1,000 per year in passive income paid out every month. Keep in mind that dividend yields can change. In strong bull markets, when the market keeps going up and call options expire worthless, the income might be slightly lower. In sideways or choppy markets, the income can be higher since the call options generate more premium. This is why many investors love JEPI. It thrives in uncertain markets. Now let's talk about risk. JEPI is not risk-free. Even though it is designed to be less volatile than the overall market, it still holds stocks. If the market crashes, JEPI will fall too, just not as much. Also, because it sells call options, JEPI gives up some upside growth. That means in a strong bull market, your returns may lag behind something like the QQQ or S&P 500 index funds. You are trading some growth potential for steady income and lower volatility. That is a fair trade-off for many income-focused investors, especially retirees or those looking for monthly cash flow. What about taxes? Here's where it gets a little tricky. JEPI's dividends are mostly considered ordinary income, not qualified dividends, because the option premiums are taxed at short-term rates. This means you could pay a higher tax rate compared to something like SCHD or VOO. If you are investing in a taxable account, you will want to talk to your tax advisor. But if you use a Roth IRA or traditional IRA, you can avoid some of those tax consequences and keep more of your income. JEPI is also one of the largest actively managed ETFs on the market, with over $30 billion in assets under management. That makes it highly liquid and very stable. You can buy or sell shares easily with tight spreads, which is important for short-term income strategies. The expense ratio is 0.35%, which is higher than a passive index fund but reasonable considering the active stock selection and the complex option overlay system. You are paying a little more for a smarter strategy and professional management. Let's walk through a quick example. Say you invest $20,000 into JEPI. If the yield is around 9%, you could receive about $1,800 per year in monthly income. That's around $150 per month. This income is not guaranteed, but it is relatively stable, especially in range-bound markets. Over time, if you reinvest those dividends, you can compound your growth and income, creating a snowball effect that builds serious wealth. Now for the final part. Let's rate JEPI using my meter rating system. First is income strength. JEPI scores a 9 out of 10. The monthly income is high, reliable, and consistent. Second is growth potential. JEPI scores a 6 out of 10. You are sacrificing some upside due to the call options. Third is volatility protection. JEPI gets a 7 out of 10. It is less volatile than most equity funds, but still exposed to the market. Fourth is tax efficiency. JEPI scores a 5 out of 10 due to ordinary income treatment, better in retirement accounts. Fifth is sustainability. JEPI gets an 8 out of 10. The strategy has proven durable across market cycles. And finally, overall, I give JEPI a total score of 8 out of 10 on my meter rating. To summarize, JEPI is one of the best ETFs for generating monthly income while reducing portfolio swings. It is perfect for investors who want reliable cash flow, professional management, and a more stable ride than traditional S&P 500 funds. If you want your money working for you without constant market anxiety, JEPI is a top contender. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.